I think a lot of investors are asking the question these days, have stocks bottomed? And that's certainly the question when we look at the Walt Disney Company. What is going on, investors? Hopefully, you guys are doing well out there. Time to take a look at Walt Disney over the last year, down 42%, year to date down 32%. And we're going to talk about the company's Q2 earnings, which came out after the bell. Revenue came in at $19.24 billion. We'll come over here and show it to you from kind of a broader perspective, but with Walt Disney as well, considering they have two very different segments of business, we'll look at those as well. We'll take a look at the media division, the movies, the TV, the ESPN, the network television. We'll also look at the parks and experiences, knowing that year over year, obviously fantastic comparable results, both on the revenue and the profit side on the parks. That is because last year at this time, they had some virus restrictions. Now they mentioned in this financial report that they have very little virus restrictions at their parks. So what we'll do is we'll compare it quarter over quarter as well and see how the demand is holding up over at the park segment as well. Then we'll come over here and look at this from a technical perspective. Like a lot of stocks, this stock has just completely fallen off the mountain. And considering Disney has been a stock that has been around a really long time, used to pay a very consistent dividend as well, was a very popular buy and hold investment. A lot of people still hold this stock and have watched it pull back. We'll talk about, is this finally an area where potentially maybe you can step in on Walt Disney shares. Now we've got revenue at about $19.24 billion. That was 23% year over year. They missed expectations on that revenue side by about $800 million, but I think the street is looking for it. Look, during the regular session, the stock was down 2.33%. After hours, it's up about the same amount, all things being equal. Disney stock, quite frankly, hasn't moved after these earnings have been announced. Street's probably looking at these Disney Plus subscribers, which we'll talk about the profitability from this business unit or the lack thereof here in a moment, but those subs came in at 137. Those subscribers were at 129.8 million in the fourth quarter. So it's nice, strong quarter over quarter growth just on that sub side. Now, we obviously could go down a deep rabbit hole with Disney, considering this company has kind of stuck their neck out into political issues, particularly in the state of Florida, where they obviously operate Disney World, and they had huge control over a very large swath of land. And then after a bill that was passed that had nothing to do with Disney and more to do with what was being taught in the state of Florida in terms of their schools, well, Disney kind of stuck their neck out and decided to have an opinion on this, and it cost that person his job. This person, Jeff Morrell, actually got fired, considering the backlash against Disney has been so bad publicly, but then also Florida passed a law that removed Disney's special tax district status and is likely to affect this company's earnings in the couple years ahead. I tell you what, I don't care what your politics are. If you're center, if you're right, if you're left, it really doesn't matter. When you look at some of the greatest investors out there, some of them are extremely conservative and some of them are extremely liberal. It really doesn't matter. But it's really dicey when these companies like Disney really try to decide and pick one side of the argument. It certainly can alienate a lot of your customer base, and it also can alienate the state government which you do business in. And as we saw, Disney's likely going to face financial ramifications from sticking its neck out on an issue like this, while a certain portion of Walt Disney's customers probably appreciate it. The damage that it did to the stock and the brand and the financials far outweigh that, in my opinion. These companies would be far better off if they stick to business and stay out of politics for the most part. Now, in terms of their results over at Disney, we saw strong growth on that Disney media side from 12.4 billion up to 13.6. What we're still seeing though on the network and kind of movie side is we're still seeing declining operating income. Notice that our revenues in that segment of business went up 9%, but our profits, or our operating profits, went down 32% from 2.8 billion down to 1.9. So we're seeing some improvement on the revenues, but not seeing that flow down through the bottom line. Some of that has to do with, obviously, you have price inflation and those types of things, but also the fact that those sports rights have just continued to exponentially get more expensive. So the profitability on those types of programs certainly weighing on the shares. We see it for the 6 months as well. You have 12% revenue growth on the media segment, and then you only had, or in this case, you had 36% declines on that operating income. Now, what's picking up the slack is those Disney parks and experience. But we talked about the year-over-year comp is really tough, okay? They're running at limited capacity. I believe out here in California, they probably had some capacity restrictions in China and also Florida where they operate. They might not have had any operational constraints in Florida, but certainly some of your customer base this time last year might not have felt comfortable going to Disney. I think it's fair to say more people feeling that, and we certainly see it in the demand for the Disney parks and experience as revenue went from $3 billion last year, more than doubled, all the way to $6.6 billion. On the profit side, Disney did a nice job with the parks. They didn't bleed a ton of money, and they did a nice job. They lost $406 million on that division last year. This year, $1.7 billion in profit from the $6.6. But what I want to show you is kind of quarter over quarter how we're looking on that Disney and parks. So in our quarter that ended January 1st, 2022, they had about $7.2 billion worth of revenue on the park side, and I just showed you they had about $6.6 billion in the most recent quarter. So a little bit of slowdown. There's certainly some seasonality to Disneyland and taking your kids, and they probably have to be off school. The fourth quarter is probably better for that than the first quarter. I'm not trying to make excuses for Disney. I'm just showing you maybe there's definitely some seasonality. This is not necessarily a fair comparison, but I just want you to digest this as an investor. And on the profit side, $2.4 billion, 1.75. I tell you what, the third and fourth quarter should be spectacular for the parks and experience side as you move into the summertime. It could be parents' first opportunity to take their kids to Disneyland, have that experience. We've certainly seen price increases as well. I think we'll likely see this revenue continue to increase, certainly year over year, but I think quarter over quarter, you should see some increases heading into the third and fourth quarter. We'll see how Disney does on the profitability side. Obviously, they have to be paying their workers. And on the expense side, when we get to these financials, we're seeing that weigh on the company just a little bit. So on that revenue side, total company, $19.2 billion, last year, $15.6. After we subtract all our cost, we notice despite the $4 billion in additional revenue, our operating income actually went down from $1.2 billion down to $1.1. So the most recent quarter was good over at Disney. Certainly saw strong profits from both the divisions, but we're still seeing the media division suffer a little bit on that profit side. We see this all talked about Disney Plus, ESPN Plus, Hulu. We're still seeing that segment of the business still running at an operating loss. So here's your operating income. This is your direct consumer. This is your Disney Plus. You had $4.9 billion worth of revenue. That was over about $4 billion from the previous year ago on a quarterly basis. That was a 23% jump on the revenue side for the Disney Plus direct to consumer over at Disney. But notice that our income from operation didn't get any better. In fact, it got worse from $290 down to $887. Now, I understand the argument. You're going to bring these people in and they're going to just continue to pay $8.99, $12.99, whatever it is, every single month. You're going to just constantly get these people on a rebill. And here we see the direct consumer product lines that Disney operates, and you're seeing really across the board pretty strong growth. Okay, up 33% just on Disney Plus, 62% growth on the subscriber side on ESPN Plus. So this company is building up a huge base of people. They're paying a ton of marketing on that. They're investing in new content. So they're not making any money right now, but the bull case thesis for Disney is eventually they will. They'll monetize that and they'll start printing large operating profits from that segment of the business. I think everybody could agree that's probably going to happen for Disney. They have just a huge library of content that they'll be able to monetize that over a longer period of time. Now, from a balance sheet perspective, everything looks pretty good. It's about the same as what we had back in October of last year, basically 6 months ago. You've got almost identical amount of assets, liabilities basically the same, nothing really to see there. Now, from a cash flow perspective, we get a 6-month view on the cash flows. The most recent quarter probably wasn't that great from a cash flow perspective, but you get $1.5 about $1.5 billion worth of cash flows last year on a 6-month basis. This year, basically flat, just up marginally. Here's one thing to talk about. We know that I have been just harping on these CEOs, from Jack Dorsey to the Shopify CEO to just a bunch of them, the equity-based compensation or the stock-based compensation. Look at Disney. They had $450 million worth of stock-based compensation. And yes, that's a lot of money, but they had net income of over $1.8 billion. They had total revenues of over $20 billion. Okay. This is a company that's generating way more profits, has way more revenues, and the stock-based compensation, quite frankly, is lower than what we're seeing at some of these unprofitable tech companies. Those are why those stocks are getting hammered, although Disney stock's getting hammered too, so I guess it doesn't matter. But from the balance sheet perspective or the cash flows, everything looks good. They repaid a little bit of debt in the most recent quarter. That's about it. Looks like they invest a little bit more in their parks. They did $1.5 billion last year, about $2 billion this year, so they went cash flow negative for the most recent period, flowing out about $2.7 billion worth of cash in the most recent quarter. All things being considered, the cash flows look okay over at Disney. If you are buying this stock, you are buying into the fact that they're going to be able to monetize those Disney Plus subscribers. They're already doing that, but eventually that will turn profitable and the parks will just continue to be that cash flow generating machine that it was prior to March of 2020. The stock, from a technical perspective, there's not a whole lot to see here. It is sliced through so many areas of support. We have to go all the way back to like 2014 on this stock. There is a bed of support. Now, when this stock bottomed out in March of 2020, like a lot of stocks, it came all the way south of about $90 per share, but very quickly recovered and hovered at about $90 for just a couple days before launching up like most stocks did. That is the area of support over at Disney. You got about $15 to go before you get to the absolute line in the sand, because if Disney breaks through this $90 level, well, I can almost guarantee the entire stock market will be making an even bigger leg lower than it already has. Because when we start looking at this from the valuation perspective, the market cap perspective, the market opportunity perspective, boy, it gets more and more attractive the more this stock continues to go down. Will I or would I step in and buy between, I would say, $90 and $100 per share on Disney? I would say in some markets, I think it would be a no-brainer, but considering we have so many stocks pulling back, there's so many values out there. I think there's stocks that are doing buybacks, there's stocks that are paying dividends, there's stocks with faster revenue growth, less headwinds, less of this political BS that I've got to deal with when it comes to Disney. Well, I tell you what, the shares are attractive to a certain degree, but so is most of the other market out there. And I think in the case of Disney, that means you've got plenty of time to accumulate these shares. I don't see some massive V-shaped recovery like we saw back here in March. I don't think that's in the cards for this market. So you have to weigh how much you like the Disney investment going into the next couple of years compared to other investments that you might want to make as well. Hopefully you guys enjoyed today's video. We'll be back in soon with more. Good luck with your investments.